Hello, and welcome to the April 20 Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joining with me is Mark Zavitz. Today, we will be discussing model portfolio performance and then going over the latest assumptions by FP Canada, the Certified Financial Planning Institute of Canada, that were released earlier this month about things like longevity, expected returns, and inflation. Why are we talking about this? Well, it's the assumptions Mark and I are expected to use with clients like you if we do any sort of financial planning. So let's get started. Markets pulled back over the month of April. All of our model portfolios are down about 1.5% to 2%. Still, we're positive on the year, but we've seen a bit of a pullback. This, in my opinion, is what's called a typical bull market correction. In March, actually, Mark and I were talking about how we kind of expected some sort of pullback because of the great returns that we'd seen specifically from the stocks in everyone's portfolio that were really driving all these returns. Stock markets over the past 6 months are up 10, 15, 20, 25%, depending on where you're looking. We've also recently seen, just in the month of April, a few companies come out with lower than expected earnings, such as McDonald's and Starbucks. All this means is that consumers could be finally starting to slow down. Who knows if it's just a blip, but that could be the first sign. The last time these companies missed earnings was when COVID hit in 2020. So does that mean we should sell everything and get defensive? Absolutely not, because we do not know how to time the market, and neither do you. In fact, this is probably not a bad buying opportunity or entry point into the market if you have either additional cash or if we've talked to you in the past about potentially making a change in your portfolio to get more aggressive, as long as it suited your long-term financial planning goals and needs. Mark, what's your take on what we're seeing in markets? And I just want to apologize real quick. I know some people are having a tough time seeing this. I tried to make this screen a little bit bigger and the performance just a little bit bigger, so it's not a big eyesore, especially if you're looking at this video on your phone or on your iPad. But Mark, what are you seeing in markets? And maybe, since I didn't talk about it yet, maybe talk about inflation and what's been the
Okay.
story for bonds this year?
All right. Well, bonds. Well, just to comment on what you said. Yeah, I think maybe the stock markets got a bit ahead of themselves at the end of the first quarter. We were kind of in a Goldilocks situation as far as economic news was concerned. And so a little bit of a pullback in April is very reasonable. So the pullback really is being triggered by inflation fears. Inflation is stickier than we want it to be, and when inflation is sticky, that means interest rates. Usually, that means interest rates are going to stay higher for longer. So, Greg, we're back to the same story with bonds. The situation in Canada is a little bit different. It's quite a bit weaker here, and rates are going to start coming down here, I would think, quite soon. But unfortunately, the American market drives the world, the financial world, and the news in the States, the economic news is pretty strong. Inflation looks like it's pretty sticky. And it looks like interest rates are going to stay higher for a little bit longer in the States, which is also going to influence the rest of the world. So Greg, earnings, except for some of the consumer companies, like you mentioned, corporate earnings are coming in quite good.
Yeah.
65, 70, 75% of the earnings are beats, meaning they're beating their forecasts. And that's really good support for the market. So we're just hoping that that we continue to see some improvement in the inflation numbers, so that bond yields can come down a little bit and the central banks can start to drop interest rates.
Completely agree. I jumped to this slide and it's a good segue here. So as you can see on this slide, you probably don't know what this is, but this is the performance of a bond market ETF called XBB, which captures the entire Canadian bond market. It's a good representation of the bonds of your portfolio and in your model, or in our model, should I say, it represents about 60, probably 70% of the bonds you own. So as you can see here, bonds, they continue to struggle. From the highs of 2020 to now, bonds are down almost 10%. And the 5-year number of Canadian bonds is virtually flat. So it hasn't given you any performance. And, as we've said, the moment we see inflation come down, we will regain a big portion of what was lost in price. We actually started to see that jump at the end of 2023. And of course, as Mark was just saying, inflation's reared its ugly head again, and we're starting to see some of that price appreciation come back. And that's because when yields and inflation go down, bonds go up in price. We were thinking, we would have 4, 5, 6, 7 rate cuts this year into next year. Now it's looking like in the States, there might only be 1 rate cut by the end of the year, maybe, and maybe 1 or 2 in Canada. But the only caveat I will throw out there is historically, whenever there are rate cuts, they typically come on very fast, and there are many of them at the same time. It doesn't typically happen over a slow, gradual pace. It did for a period in the 80s, for a small period in the 80s, but most of the time, we would go from a 5% interest rate to say a 3 or 2.5% handle over the course of 6 months, 9 months, something like that. So when it does go down, it typically goes down fast. So now on to the Financial Planning Canada assumptions to be used in financial planning. So these are the numbers Mark and I are expected to use when framing out the expected growth of your portfolio. Now, as you can see, the numbers specifically for return rates are quite low. Financial Planning Canada is notorious for understating their future expected growth numbers. But of course, it's probably prudent to do so. And for Mark and I to use numbers like this so that we don't end up putting you in a position where we underpromise. We want to end up in a position where we underpromise but over-deliver. But given these numbers, and this is a 10-year expected return number, I typically deviate by about 0.5% higher in terms of the expected returns, which is, when it comes to the CFP guidelines of how I should be conducting myself, okay. Historically, though, and I just took a look at what the actual returns were for Canadian markets and US markets, I would say that these expected equity market return numbers are about 1% on average understated from the actual performance that we've seen. Again, it's probably better, or it is better for the guidelines to show lower performance so that we don't overestimate the performance of someone's portfolio and assume that they're going to have more money or more income than they actually wind up having. And finally, this is the cool one. It's FP Canada's mortality table. It might be a little tough for you to see, so I'll try to highlight here with the laser point feature. So how do we read this? Well, if we start at the top, you can see the probability row from 10 to 50%. So in this column here, you can see the starting age in 2024. The way to read this is if you are a 20-year-old male in 2024, you have a 10% chance of living to the age of 99. If you're 20 years old this year, you have a 10% chance of living until you're 101. Now, for many of our clients who are in the ages between, say, 50 and 70, I'll start at 50. If you are 50 years old today, you have a 10% chance of living as a male to the age of 98. And you have a 50% chance, if you go to the far right column, you have a 50% chance of living to the age of 89. And if you're a female, you have a 50% chance of living until 92. Combined, there is a 50% chance one of you is going to live until 95. Mark, I mean, you've been a CFP for a long time. When you started in the business 40 years ago, what was life expectancy like? I mean, you were relying on the insurance companies back then. When you first got into doing financial planning, and why would you say this is important?
Well, Greg, people are certainly living a lot longer, and mortality rates have changed significantly in the last 30 or 40 years. When I first started, people were retiring at 65, and men were living 10, 15 years. Women were living 15, maybe 20 years, if they were healthy at age 65. So, when we were looking at how, the amount of capital that was required to provide the cash flow that they needed for their retirement income and for their estate, monies that they wanted to pass on to their kids or charity, we really were dealing with 65 to 80, maybe a 15, 20-year time horizon. And today we're dealing with a 30-year time horizon. So we've got to be a lot more cautious.
Yeah.
Because like you said, there's a 1 in 2 chance that, a couple today that's retiring at 65 in good health, there's a 50% chance one of them is going to be alive still at age 95.
Yeah. Yeah. I mean, we need our capital to last, right? And we need to supply us with an income, not for 15 or 20 years, for 30 years or 35 years in some cases, depending on when you retire. It does make this a more challenging situation for financial planners, and it keeps evolving over time. I mean, modern medicine, technology, all these things, all these advancements, they just keep increasing longevity, which is not a bad thing, but obviously something to consider for everyone.
Oh, exactly. It's just it's a significant consideration, right? Longevity.
Yeah. Yeah. Okay. So those were the two cool pieces that I wanted to show you. This is kind of insider information to the knowledge that market get sent to us by FP Canada Institute. I'm going to end on the disclaimer. Just want to say thank you so much, everyone, for listening to our update. And we hope you have a good month of May, and we look forward to our next monthly update, which we will send you at the end of the month. All right. Take care. Bye now.
Thanks, everyone.